Okay, so we are going to get started live on Facebook and live um, on YouTube. Okay, so we are going here. Okay, so welcome everybody. My name is, oh, I'm going to give that a minute there. Okay, and yes, I realize we are going to be sharing stuff on the World Wide Web. Okay, so welcome to Money Matters, everybody. My name is Huong. I am with Cash Property. So in the next 30 minutes, we are going to be analyzing a deal. So today we're going to talk about cash flow. And of course, in real estate, we're always talking about cash flow. And then there was a question that came in as well about GP and LP structure. So we will definitely go into that as well. So we are February the 19th, and it is Family Day Monday. And so, of course, today's supposed to be a holiday, but I am still committed to doing these sessions every Monday, regardless of the situation. Except I think I skipped one or two holidays. So we are going to be able to do it today. So which is why I am on. And, part of the reason of doing these calls on Mondays, regardless if it's a holiday or not, is that we want our money to be working for us while we're sleeping, while it's a holiday. It doesn't matter. Okay. So the outcomes of these calls is really for me to give back to other fellow accredited investors who are trying to grow their net worth, make sound investment opportunities. And so my focus has always been in real estate. So in the next 30 minutes, we're going to be looking at achieving that. All right. So before you go and implement any of the stuff that I'm talking about, please go and seek somebody else's opinion. This is, really what I'm doing for my family. And so I'm hoping it may give you some ideas on what you can be doing. Okay, so we got that one. Okay, so we are going into the cash flow topic here. So cash flow in real estate is like everything, like every single time you talk about an opportunity within real estate, you're going to ask about the cash flow. You're going to be talking about the concepts of the cash flow. So the first thing that I want to make sure that we all understand about cash flow is that cash flow it can be positive or negative, okay? And the cash flow is all of the income from that one opportunity. So if we're talking about a multifamily, we're going to be looking at all the rents, any special fees that you charge for cleaning, parking, laundry, any type of those things, okay? All of that is the incoming cash flow minus all of your expenses, okay? So that is all of the utilities, any of the debt servicing, like the mortgage, any private lending you have, and tax bills, all of that stuff, rent rebates, okay? Gift cards that you send out to your contractors or your tenants, all of those stuff are expenses. And once you take your incomes coming in and minus all of your expenses, that's your cash flow. Okay, that is your net cash flow. And you want that ideally to be positive. Okay, so let me share my spreadsheet and let's see how that all works out. Okay, so we got this cash flow analysis sheet. So I just need to share that. Okay, and I want to make sure that I'm sharing it because a few times I've caught myself not sharing stuff and I'm like, oh no. Okay, so here is the calculation sheet that I like to use. So when you get down to this part of the number here, this net cash flow, that is the number that you want to look at. Now, cash flow is only one number to look at, but it's a really important number. So that's why I sort of want to make sure that we go through that today. Okay, so when you are looking at this cash flow number, you want it to be more positive. Okay, the higher the better. Okay, the closer to the zero number, well, then you're sort of taking a bit of a risk there. Okay, so the first thing to keep in mind is with this cash flow, it's all of the income. Okay, so all of the rental incomes, whatever services you're providing on that property, all of that stuff, minus all of your expenses. Okay, so now when you're doing this calculation, you want to look at it on the same time frame. So if you're looking at your income for 1 year, then you want to look at your expenses for 1 year. So it's on the same time period. Okay, all of the expenses, including your mortgage, all of your debt servicing. So if you have to get a private lender on this, you want to include that interest that you're paying for that debt servicing as part of your cash flow. When I'm running my numbers here, a common mistake that I see across the board is number one, people don't include the expenses for legals and accounting. You have to pay for that. Okay. You may not need oops, sorry. You may not need a lawyer every single year, but you should at least account for some fees for your bookkeeping and your accounting. Okay. So that, oh, and then the other big mistake that I see is that people don't include a fee for their CapEx, and they don't include enough for property management. Even if you're self-managing, you still want to include a percentage in there, okay? So when I run my numbers, I always include a set number in there. And then for property management, for repairs, vacancy, okay, and then the other. So the other could be for sewage charges, depending on what city you're in, garage pickup, camera security. Okay, so you want to make sure that you include those numbers in there. That's all part of your expenses going out for the year. And so when you're calculating your cash flow, it's all of the ins minus your outs. Okay, like I can't stress that enough. Okay. And a lot of times when you're talking to real estate agents, they don't understand that concept about cash flowing includes all of your debt servicing. Okay, so just make sure that you understand that for yourself. Okay, so now this cash flow, everybody's talking about, okay, Huong, when you buy something, you want to be in positive cash flow. Absolutely, I agree with that statement 100%. Okay, so here's the reason why, is because if it's not positive cash flowing now, at some point when you go to refinance this building, so in this case, we have, in this example here, we're running a mortgage at 1.72, which is so cheap, okay? But now let's just say for some reason, in this particular case, we're getting an assumable mortgage, okay? So what I'm going to do is I'm just going to change that to 0, because we're not going to have an assumable mortgage on this case. I'm going to change that to 0, okay? So now what's going to happen is now I'm going to need to put down a 20% down payment as a minimum, okay? So that means now my down payment amount, okay, so now, as you can see, I'm updating the formulas here because when you have an assumable mortgage, that changes the calculations a little bit. Okay, so I'm just taking my buying price times my down payment of 20%, okay? So that means I'm going to have a down payment of $660,000, okay? So that means I need to have $660,000, or my money partner has to have $660,000, okay? So then the balance really is the buying price minus that down payment. Okay, so it's a really easy calculation here. I'm going to change the VTB to 0%. Okay, so we're not going to have a VTB here. I'm going to get rid of this balance here. Oh, not that one, the 450. Okay, so in this case now, I'm going to have a mortgage of 2.6 million based on this purchase price. Okay, so I'm buying it for 3.3 million here. So the balance that I need to go out and get a mortgage on is 2.6 million. So let's just say that the interest rate now is 6%, which is what we're seeing. Some CMHC programs right now are coming back with some better stuff. Okay, so I'm going to get rid of this note here on interest only because it's not interest only. And what we're going to do is we're going to calculate our principal amount going in. Okay, so to do that, it's a formula in Excel. So I'm not changing anything here, okay? So I'm just going to put that back in because I want to show you, and I have a negative in front of the PMT calculation because it's an expense going out. Okay, so I'm going to divide that by 12 for each month. My present, the NP and the number of payments. Okay, so I'm going to put 360 in there. Okay, because that's I think that's the number for 25 years or something like that. And then the present value is this 2.6, and the future value is 0. Okay, and then we're going to just go at the end of the period. Okay, there we go. So my mortgage payment on this is going to be $15,000 a month. Okay, based on 6%. Okay, so once you have this calculation, okay, you can see my cash flow changed massively here. It went from a positive I don't know, what was that, a couple of $1,000s, okay, to minus 1,600. Okay, so now 1,600, sorry, minus $116, that's not a lot, okay? But what you want to keep in mind though, okay, and this is per month, so every single month I'm going to be paying out $116, okay? So you have to keep that in mind that you're going to be paying this $116, okay? So one of the points that I want to get across to you is that if you can get a lower mortgage than this, so let's say you got this mortgage at 3%, okay, your mortgage payments every month goes down. So your cash flow will go up, which is fantastic, okay? So that's what you want to do. So now when you're running your numbers for today, you want to make sure, okay, so if I got a 3% mortgage today, I'm going to be cash flowing. But at some point when you go to refinance, if you have to get a higher mortgage, okay, let's say at 6%, you're going to be negative cash flowing. And so that's where, you know, when you go through the underwriting, a lot of these underwriters will stress test the opportunity for you. So when you're doing your own analysis, you also want to be stress testing your own property too. So just because you're buying it today and getting financing at 3, you want to make sure that, okay, let's just say the expenses are a little bit higher for that one particular year. You've got a little bit more renovations because some of your tenants, you know, weren't very nice, or you got hit with a super insane insurance bill. Okay, you want some extra fluff there. Okay, so that's part of the stress testing. So let's just say now, you know, at 3% interest rate on this mortgage, you're going to be cash flowing at around 4,500. But if you went up to even 6%, the way you're cash flowing at this point, okay? So part of this cash flowing number is really, really important. So now the other thing I want to point out about this cash flow is that this cash flow, okay, is tax, like you have to pay taxes on this, okay, at the end of the year. This is income, okay? So that's one of the reasons why I say like cash flow is not enough, okay? A lot of people, when they're buying real estate, when they're buying business opportunities, they look at the cash flow, which is fantastic. But one thing that they're not even looking at is the appreciation. Okay, so let me share this next slide with you because I sort of want to make sure that this is also shared as well. So give me a second here. Let me share my screen here. Okay, so this is the concept of camping. Okay, when you are investing in real estate, you want to be camping. Okay, and I love camping, so this message really is easy for me to understand. Okay, so I hope you like camping as much as I do. So, you know, when I'm camping, I'm still doing real estate stuff. Like I did one of my webinars one time out my tent. You know, when I take my kid camping, we're playing cash flow and we're, you know, constantly talking about real estate and money and stuff. Okay, so when you are investing in real estate, you want to be camping. Okay, camping should be one of the first things that you think about when you're talking about real estate. Okay, so camping stands for cash flow appreciation, mortgage pay down, increasing net worth for generations. Okay, so cash flow is great, but you also want to look at the appreciation. Okay, mortgage pay down is going to happen no matter what, assuming that you're paying down the principal. Okay, if you've just got private lending all over on your property, on your opportunity, then you're not going to have mortgage pay down. So you want to get out of your private lending as much as possible. Okay, so with the appreciation, this is not taxed. Okay, so you heard me correctly when I said it's not taxed. Okay, so the way the appreciation works is you buy a property now, okay, it increases very passively. So we're talking about passive appreciation here. It increases year over year over year over year, okay? The great thing about appreciation is that it's compounding on itself, okay? Like the magic of compounding interest is what will give people their generational wealth, that financial freedom. Okay, this is one of the hidden magics about real estate. Okay, so if you're buying for cash flow and you're buying for cash flow only, okay, it's good. Okay, but you can do so much better if appreciation is thrown in there. Okay, so let's just say, for example, you're buying your property and you only get, you know, that $1,000 a month in cash flow. Okay. Well, that's 12,000 at the end of the year. Okay. 1,000 a month times 12, 12,000. Okay. When you get that 12,000 and you're taxed, okay, that is a taxable income amount. Okay. Even if like, because it's your net cash flow, like you've already written off all your expenses. Okay. So that total amount is what you're being taxed at. Okay. The amount that you're taxed on that depends on if it's under your personal name or under a corporation. Okay, so you do want to go talk to your accountant about that. So now this appreciation amount, okay, when I say it's not taxed, it's because you buy the property today, it's appreciation year over year over year. Okay, well, let's just say in 5 years, you go to refinance. Okay, when you go to refinance that, you pull that money out, meaning that the bank's going to give you a higher mortgage, a newer mortgage. Well, that chunk of money, okay, you've just refinanced that, pulled that out. Okay, you don't have to pay taxes on it. Okay, you then take that money and you either live off of it. Okay, so it's sort of like, you know, living off of that money because you've been sitting on that money for years and years and years. Okay, or the or is what I would recommend. Or you go and you take that appreciation amount that you just got, this big, huge chunk, okay, and you go and you buy another investment. Don't just be like, okay, I'm just going to go buy a boat and live off the boat, which is what I would do, unless you're going to be able to rent out that boat too, okay? So let me show you what that means by the appreciation amount, okay? And why that really is like the gravy on top of the cash flow. And okay, okay, so I'm getting a bit ahead of myself here with my thinking here. So I want to show you guys that. Okay, so let's go back to that spreadsheet here. Okay, so we want to go into the cash flow spreadsheet again. Okay, I was so excited to share this stuff with you guys. I was like, oh, I'm all giggly about it. Okay, so here's the cash flow spreadsheet here. Okay, so this is the cash flow that you're going to be making. Okay, so now if you were to go to a mortgage table, this mortgage table you can get online, like once there's tons of websites that you can go to like calculate your mortgage and stuff like that. Okay, so let's see, why is this one? Oh, I haven't entered any data in this one. Okay, so let's see. Okay, here we go. So one of the things that you can calculate is one, your mortgage pay down, but also your appreciation amount. Okay, so let's see if we've got one coming up here. No, we don't have that. Okay, so let me unshare this and let me take you to another appreciation chart here. Okay, so give me 1 second here. 8plex calc. Do we have it in there? Let me see. Oh, it is just loading. My Excel sheet's just loading. So if not, it may be under, whoop, there we go. Okay, yes, so we can show it on here. Okay. I don't know where the links are coming from. Okay, so let's just say, yeah, I'm not sure what calculation this was for. So let's just say we have a building that we're buying in 2018 for $373,000 and we appreciate it by 3%. So 3% is not a great appreciation number, but across Canada, that's sort of the average. But this will show you the idea here. Okay, so after 5 years, so from 2018 to 2022 or 2023, that's your 5 years there. Okay, so every single year, this property is going, oh, let me see. Okay, oh, sorry, let me just share my screen again. See, it caught myself not sharing there. Okay, share. No, I don't want to share that one. Where is it? This one. Okay, so you will see a new Excel sheet here. Okay, so if I'm buying this property at 373 and I sit on it for 5 years, it's been appreciating, and there's a 3% appreciation. Well, every single year you can see it's just basically going up by 3%. Okay, so my 373 times 3%. So the first year I'm making 11,000 just from the appreciation. The second year I'm making 11.5 because it's compounding on that initial appreciation for the first year. The third year I make 11.8. The fourth year, I'm making 12.2. So as you can see, this number is increasing year over year because it's compounding on itself. Okay. So at the end of the fifth year, I've got a total of $60,000, 59.4. Okay, $60,000. When I go to the bank and say, hey, Mr. Banker, can you refinance my building? They're going to give me a check pretty much close to that 60,000. Okay. I take that 60,000 and go do another investment with it. Okay. So, and then this 60,000 is not taxed. Okay. Like it's nowhere on CRA's radar. Okay. So that is the power of this hidden appreciation because it's compounding on itself. And it's not one where you can go in every year and take it out. Like if you take this 3% out every year, then you've lost that power of compounding. So you want that money to stay in there. So now let's just say we increase this 3% to 10%. Okay. Look at this, like some of these cells don't even have enough space to show the numbers. Okay, so on this particular opportunity now, we're growing at 37,000 a year for the first year, 41,000 the second, 45,000 the third year. So by the end of my fifth year, I've got $227,000 in appreciation. That's like almost like where I started from at the 373. Okay. So now I can take this and go and buy another building or do another opportunity. Okay. So that's the power of the compounding effect from appreciation. Okay. And this is not even talking about forced appreciation. Like if you could add in a secondary suite, convert some of your bigger one bedrooms to smaller two bedrooms. Okay. There's so many ways to do forced appreciation here as well. Okay, so that's the importance of the cash flow. Like you want to make sure that you don't just look at cash flow by itself as one number. Okay, you want to figure out, okay, well, if I'm looking at an opportunity, is the appreciation there as well? Okay, so now keep in mind that, so when you're calculating your return on investment, okay, you are going to be adding in your appreciation, your cash flow, and your mortgage pay down. All of that together is your return on investment. So you remember when we were talking about this, the camping concept, right? When you are calculating your return on investment, you're going to include cash flow, appreciation, and mortgage pay down. You should have a percentage for each of these three things, okay? The addition of those three things, okay, the combination of those three things is what your return is. Okay, now the thing that I want to point out really importantly around calculating your return is that if you have a property for 5 years and you're calculating this, okay, so let me go back to the Excel sheet here. Okay, and I'm actually just going to see if I can just go back to doing a direct share without closing anything down. Okay, so when you're calculating your ROI, okay, you want your cash flow, appreciation, and you want your mortgage pay down. Okay, so let's just say, for example, your cash flow is 5%. Okay, you've got a 7% appreciation. So now I'm just picking numbers out from space so you could see it. So when you do your calculation, you're going to want those to be realistic. Okay, and your mortgage pay down, let's just say it's about, oh, not 35, 3%. Okay, cash flow 5, and this is 3% here. Okay, so your ROI on this, okay, is going to be the sum of those three percentages. Okay, so if you've got a 15% ROI, you might be thinking, oh, wow, that's fantastic. Okay, but now here's the problem though, is that you want to make sure that this is per year. Okay. So if your cash flow per year is 5%, that's fantastic. If your appreciation is 5%, that's fantastic. Okay. And your mortgage pay down every year is per year. Okay. So this 15% is really, really good. So then you've done this calculation right. Okay. So now sometimes what I'll see from opportunities is they'll present whatever the cash flow is for a 5-year period. So they'll actually say, okay, well, the cash flow is 25, the appreciation is 35, and the mortgage pay down is 15%. And what they'll do is they'll lump it all together and they'll say total ROI. Okay. Now this is misleading because you're thinking, oh, wow, I'm getting 75% ROI. Okay. it doesn't work that way. Okay, you have to divide it by the number of years. So in this case, we're saying it's a 5-year program. Okay, so then your ROI is actually 75% divided by 5. Okay, and so then you convert that to a percentage point. And it's not letting me. Why isn't it? Okay, sorry. Oh, I was going the wrong way there. Okay, so that means per year it's 15%. Okay, so that's how you want to take that calculation into consideration. So as you can see, your cash flow is just a certain percentage. Okay, and if we were to go back to the other spreadsheet where we had like $4,000 a month in cash flow, okay, well, by the end of the year, okay, you would have 4,000 times 12. Okay, so that's your total cash flow, but then you need to divide that by your initial investment that you put in. Okay, if that makes sense. Okay, so let me go back and I'll show you that. So where are we here on this spreadsheet here? Oh, no, that's the GP one. That is for one of the questions that I'm going to be answering when we come back, when we are done this calculation. Okay, so here is the, okay, so here's this mortgage here. So we're saying that the cash flow is 4,500, okay? So if you wanted to calculate your ROI on this, you would just go 4,005, okay, 4,005 times 12, okay? Close your brackets on that, okay? And then what you're gonna do is you're gonna divide it, okay, by your 660. That's the initial amount that you invested in. Okay, now it's giving me a dollar number, which we don't want. So we want it as a percentage. Okay, so that means that my cash flow here is giving me an 8% cash flow return. Okay, that's 1 year. Okay, so that's actually not that bad. Okay, that's pretty good. So this 8%, so I like to look at to a decimal point at least. So that's 8.3%. Okay, so when you're calculating your ROI, you would have this as your percentage point. And let's just say this is in a great area and we're getting 10% appreciation. Okay. And then the mortgage pay down, which we were looking here, but this one is not the right calculation here. Yeah, because this one's based on the 1.2. Oh, sorry, the 1.7. So let's just say we're going to go with the 3% here for the mortgage pay down. Okay. Okay. So then you're going to take the sum of that. Did I not do? Yeah. Okay, so you're going to take the sum of those 3 cells, and that's per year already. So then your ROI, or your internal rate of return for that 1 year, is 21.3%. Okay, all right, so that is the cash flow. I want to make sure that I cover all the points that I wanted to cover on my cash flow card, which I don't see. Okay, I've lost my cash flow card. All right, so if I miss anything, oh, there it is, I see it. Okay, so in terms of the cash flow, okay, so you want to make sure that your negative cash flow is that you're not in negative cash flow. Okay, you want to make sure that you're positive. Do your own mortgage stress test on it. It is tax. We did look at the compounding interest effect on your returns. And basically, yeah, cash flow is not enough. Like, you want to make sure that you have more than just the cash flow coming in from every opportunity. So the other thing that I want to bring up on this is that if you are negative cash flowing, okay, there are times when that is okay to be negative cash flowing. So let's just say you've had this property now and you've been sitting on it, you go and you refinance, okay, and then you pull out your mortgage and you're at 6%. Okay, well, that's fine. So now when you refinance this, you're pulling out all of that equity. Okay, if you pull out that equity and you do another investment, and let's just say you do a private lending or you go buy another opportunity, as long as that opportunity is making significant cash flow for you, enough to cover this negative cash flow, okay, so you have one opportunity covering this one so that it's not coming out of your own pocket, but coming from another opportunity, then that may make sense. Okay, so in the environment where we had really low interest rates and borrowing funds from a HELOC to do private lending with, to do investments with, that made sense because the interest, like the cost of borrowing was so low, so that, we would be making 12% somewhere and our mortgage would only be 6% here, right? So it's a negative, like in this case, negative 0.2%. So the effective return was very positive. Okay. So that would be the only time where I would say, you know what, it may make sense to have a negative cash flowing in one property if you could take funds from that one property to go do something else with it that gives you a huger, bigger return. Okay. I think I've talked cash flow to death on this one. All right. So let me unshare this. Okay. So I have a question that came through, and that was like a whole 30 minutes there. Okay. So I had a question that came through about GPLP. Okay. And the question is, Huong, can you expand more on the GPLP calculations and talk about the splits? Okay. So I understand that GPLP calculations can be quite difficult, especially if you're working with investor money. Like you want to be so on top of your calculations because you're affecting somebody else's livelihood. Like I cannot stress that enough. Okay, so let me share the GPLP spreadsheet with you, and let's see if we can make some sense of this. Did I lose my GP? Oh, no, there it is. Okay, so this is a sample GPLP spreadsheet that I've put together and used before on the show. So, let me walk through this. Okay, so here's an example here. So we've got 25% return every single year, okay, which is great. So let's just say I'm going to come in at 10%, okay, and my working partner is going to come in at 40. Okay, oh, and she's got a name here, Tamara. Okay, so there's Tamara and me, we're partnering together. And this is a 50-50 here, okay? So you can see the percentages here. So we're going to get 40%, 10%, and so the breakdown of that 25%, okay, is 10%. So the way to calculate that is I'm basically taking 25%, timesing it by 40. Okay, that's her 10. And then my percentage is only 2.5. And that's calculated by taking my ROI for that one particular year, timesing it by 10%. Okay, so now this is assuming that we're getting our percentage from year one. Okay, sometimes with GPLPs, the GPs don't get paid for a few years. Okay, so in this case, just to make the numbers easy in this example, we're getting paid from the first year as well. Okay, so now what's happening is that the LPs, okay, the LPs are the limited partners, they're coming in, and in this case, we've got 3 of them. They're each coming in and they're going to together, all 3 of them are going to share 50% because it's a 50-50 split. Okay, and each person is coming in with a slightly different amount. So this LP1 is coming in with 150, LP2 is coming in with 100,000, and LP3 is coming in with 175,000. So to calculate their percentage, okay, so if you add up the 3 of them, that's 50%. Okay, am I right on that? Let me see. Yeah, 50%. So I'm looking down here at the bottom of my screen because that's where the sum of it is. Okay, so of course I have a formula in its place. So what it's doing, it's taking the 150 that this particular investor put in, and I am dividing it by the total amount of money that we raised. So this would be for down payment, reserve costs, any due diligence costs, any closing costs. So this is the total amount of money that we've had to bring in. Okay, so 425,000 in this case. They're going to split, and then it's based on a calculation for 50%. So this LP has 17.6%. That's his take of the 50 out of the whole 100. Okay, and then this person who came in with 100,000 is going to get 11.8%, and the calculation is exactly the same. I take their 100,000 divided by the 425,000 that we had to raise, okay, times the percentage that is divvied up to them. So if you were to add up all of the percentages here, okay, it is 100%. Okay, and once you get to 100%, then you know you've done the math right. Okay. So now let's just say my number here is 0. Okay. And Tamara was able to do this deal 100% on her own. Okay. So that means she would get 50%. Okay. So as you can see, Tamara here now has 50%. All of the other investors, their percentage points hasn't changed, right? Because it's a 50-50. Okay. So now, and then tomorrow's percentage would go up, right? For every single year. Okay, that's perfect. So now let's just say instead of a 50-50 split, it's a 40-60 split. So you can see here the LP split is 60%. Okay. So their split for each of the LPs now, their percentage points have gone up. They've put in the same amount of money, okay, but their percentage equity in this opportunity has gone up, okay? So which then means that their percentage of that ROI has also gone up, okay? Because it's based on percentages. Okay, so now if you add up the 10, 0, 5.3, 3.5, and the 6.2, you'll get your 25%, which is the return on the year. Okay, so this is all math. Okay, so now let's just say there's only 2 investors, this LP number. So instead of this person coming in at 175, they didn't put anything in. Okay, so now what happens is, though, we don't have enough money to close. Okay, so if you calculate this up, we are short. Oh, no, we don't want that. Okay, so we still need a total here. So I'm going to increase, what was that number that we needed? 425. Okay, so this one is just saying, okay, well, if we had the opportunity, it's only worth 250. Okay, so I'm going to now go and split this up. So I'm going to just say that was 300,000 here. I'm just going to say that this guy came in with 300,000. Okay, and this guy's going to come in with 120. Oh, you know what? I'm going to make that first guy come in with the whole new amount, 25,000. Okay, so 425. Okay, so there's your okay, so okay, let me go back to the 40% for tomorrow here. Okay, so she still makes the 40%. Okay, now in this case here, we have 60% going to the LPs. They've come in with a total of 325 and 100. So you could see as their numbers change and with the number of people, their percentages change, right? Because it was only 425 that they still needed to come in with. That amount hasn't changed, but the amount that each one of them had to put in has changed. So this 100K person came in with the 14.1%. The other guy came in with almost 45%. Okay, so now this does create some other issues, okay? Because here, now this LP actually has more shares than this working partner. So you do want to make sure that your contracts are written correctly, where the working partner always has at least 51% of the decision-making power and the ownership, okay? The LPs want it passive, so they don't want to be inheriting problems or decision-making power or anything like that anyways. Okay, so there you go. Okay, so if you have any questions about this, okay, please feel free to email me and I will answer them on the call. Okay, you can use the QR code to book a time to chit chat about real estate. Happy to do that. Thank you everybody for watching. Happy Monday, happy family day weekend. Yeah, hope you guys have a super awesome long weekend. Okay, thanks everybody. Bye-bye.